Have you ever wondered why day trading is often seen as one of the most challenging ways to make money? Well, it's not just because you're attempting to navigate the vast and unpredictable seas of the financial market. It's also because day trading is a high-risk, high-reward endeavor. It's like a thrilling roller coaster ride, packed with exhilarating highs and stomach-churning lows. Now imagine trying to time this roller coaster. This is one of the primary challenges of day trading. Timing the market. You're not just buying and selling assets. You're trying to predict the exact moment when the market will rise or fall. It's a bit like trying to catch a falling knife or jumping onto a moving train. It's risky, it's unpredictable, and it's not for the faint of heart. Yet timing is just one piece of the puzzle. Another major challenge lies in managing your emotions. The market can be a heartless beast, impervious to your hopes and fears. One moment, you're riding high on a successful trade. The next, you're plummeting into the depths of a loss. It's a whirlwind of excitement, anxiety, elation, and despair. And in the midst of this emotional storm, you must remain calm, composed, and rational. This brings us to the third challenge of day trading, maintaining discipline. Discipline is the anchor that steadies your ship in the turbulent market seas. It's the commitment to stick to your chosen strategy, even when the market is tempting you with potential quick wins or scaring you with potential losses. It's the ability to say no to impulsive decisions and yes to informed, calculated risks. So how do you overcome these challenges? Well, it all boils down to one crucial factor: your strategy. A good trading strategy is like a compass guiding you through the market wilderness. It helps you time your trades, manage your emotions, and maintain your discipline. It's your best defense against the risks of day trading and your best weapon for seizing its rewards. So the question remains, how do you choose the right strategy for your day trading? First up on our list of strategies is scalping, a method that's all about speed and quantity. Imagine a fast-paced environment where quick decisions are made and profits are taken almost instantaneously. That's the world of scalping. It's a strategy that focuses on making a large number of trades, each aiming to profit from small price changes. Scalping is like being a swift pickpocket in the bustling market of day trading. You're not looking for the big score, but rather a series of small, quick gains. This approach can lead to consistent profits if executed correctly. The beauty of scalping lies in its potential for consistency. If you're scalping, you're not waiting for that one big trade to make your day. Instead, you're nibbling at the market, taking small bites that can add up to a satisfying meal. Another advantage of scalping is the limited exposure to market risk. Since you're in and out of the market quickly, you're less exposed to the potential downturns that can happen over a longer period. It's like running through the raindrops in a storm. You might get a bit wet, but you're not out there long enough to get soaked. But let's not sugarcoat it. Scalping isn't for everyone. It requires a high win rate. Even a few bad trades can wipe out your gains due to the thin profit margins. It's a strategy that calls for a disciplined approach, a keen understanding of the market, and the ability to make quick decisions. And let's not forget the commitment. Scalping is not a set-and-forget strategy. It demands your constant attention and a high level of commitment to your trading desk. So, is scalping for you? It's a strategy that thrives on speed, precision, and volume. It's a world where the quick-witted survive and the slow to decide are left behind. Scalping requires speed, precision, and a high level of commitment to your trading desk. Is that your style, or do you prefer something a bit slower paced? Next, let's talk about momentum trading, a strategy that's all about following the crowd. In the ever-evolving world of stock trading, momentum trading stands out as a strategy that thrives on trends. It's a method that involves buying stocks that are trending upwards and selling stocks that are on a downward trend. Sounds simple, right? Well, simplicity is one of its major perks. This strategy is fairly straightforward and can be a good fit for those who prefer to keep things uncomplicated. But as you might guess, the potential for large profits is the real draw here. As momentum traders, we ride the wave of market trends, leveraging the power of the crowd to make a profit. Imagine catching a wave just as it's about to peak, riding it to its zenith, and then hopping off just before it crashes. That's the thrill of momentum trading. But let's not sugarcoat it. There are downsides to this method, the most significant being the risk of buying at the top or selling at the bottom. Timing is everything in momentum trading. If you're late to the party, you might end up buying a stock at its peak price, only to watch it plummet moments later. Likewise, selling a stock just as it's about to rebound can be like missing out on a gold mine. And then there's the need for constant market monitoring. Momentum trading isn't a set it and forget it kind of strategy. It requires keeping a close eye on market trends and being ready to act at a moment's notice. This can be time-consuming and may not be ideal for those who prefer a more hands-off approach. So there you have it. Momentum trading in a nutshell. It's a strategy that demands a keen eye, impeccable timing, and a willingness to follow the crowd. It's about riding the wave of market trends and knowing when to jump off. Momentum trading requires a keen eye for trends and a willingness to go with the flow. Does that sound like you? Or do you prefer a strategy that's a bit more independent? Finally, we have swing trading, a strategy that's all about patience and timing. Swing trading is a game of anticipation. It's about picking the right moment to strike, capturing the larger price movements that tend to play out over several days to even weeks. Unlike scalping or momentum trading, swing trading is not about quick, in-the-moment decisions. It's about careful planning, patience, and a keen eye for market trends. Now, what makes swing trading so appealing? For one, it offers the potential for significant profits. With swing trading, you're not looking for small, incremental gains. You're looking for those big swings, those significant price movements that can really boost your bottom line. It's like fishing for the big catch rather than settling for the small fry. Another advantage of swing trading is that it doesn't require you to be glued to your screen all day. You don't need to monitor every tick of the market. You can set your targets, place your trades, and then let the market do its thing. This makes swing trading a more relaxed and less stressful approach compared to other trading strategies. But swing trading is not without its challenges. One of the major downsides is the increased risk that comes from holding positions overnight or over the weekend. Markets can shift dramatically when you're not watching, and that can lead to significant losses. Moreover, swing trading requires a solid understanding of both technical and fundamental analysis. You need to be able to read the market, understand the forces that drive price movements, and anticipate future trends. It's not enough to just follow the crowd. You need to understand why the crowd is moving in a certain direction and whether that movement is likely to continue or reverse. Swing trading requires patience, discipline, and a deep understanding of the market. Does that sound like your style? Or do you prefer something a bit faster paced? So which strategy is right for you? Scalping, momentum trading, or swing trading? Allow me to recap the key points of each strategy to help you make an informed decision. Scalping is the quick-fire strategy. It's all about making numerous trades within a day, capitalizing on small price changes. It's a fast-paced game, requiring constant attention and quick decision-making. If you thrive in a high-octane environment and have the time to dedicate, scalping may be your game. Momentum trading, on the other hand, is about riding the wave. It's about identifying stocks or other assets that are moving in a strong direction and jumping on board. This strategy requires a keen eye for trends and a good understanding of market dynamics. If you're the type who enjoys surfing the market waves and can patiently wait for the right moment, momentum trading may be your style. Then we have swing trading, the long game. This strategy involves holding on to trades for several days to weeks, aiming to catch the swings in the market. It requires patience, a good understanding of market trends, and a higher risk tolerance as trades are held over a longer period. So, if you're a strategic thinker with a stomach for some risk, swing trading could be up your alley. Choosing a strategy isn't just about understanding the mechanics though. It's about understanding yourself. Consider your personality, your lifestyle, and your risk tolerance. Are you quick and decisive, or do you prefer to take your time and think things through? Can you handle the stress of rapid-fire trading, or are you more comfortable with a slower pace? It's also about consistency. The most successful traders are those who find a strategy that suits them and stick to it. They understand that trading is a marathon, not a sprint. It's about making consistent gains over time, not just chasing quick wins. Remember, the best strategy is the one that you can stick to consistently. So choose wisely and happy trading.